Hi guys, it's Todd. I got my notes like always to make sure I don't miss any points. Well, we all know that the Federal Reserve Bank has cut interest rates by about 0.25%. So what does this mean for you? How is this going to affect your life? Well, it pretty much means nothing. It's not going to improve your life or make your life any better or make your life any worse. Now, let me explain why. The United States Federal Reserve Bank operates on the principle of supply-side economics, which means that they think that if they cut interest rates, it's going to make it cheaper for companies to borrow money. And they're going to use that savings to invest in more equipment and more tools and therefore make more product. And from there, they'll hire more people. And this should stimulate the economy. But if you ever own a business or ever operated a business, you know that it doesn't matter how much they cut taxes or reduce the interest rate. That's not going to cause you to buy more equipment or buy more tools or make more products and thus hire more people. The only way you're going to make more product is if you have a potential customer who's going to purchase those particular products. You're not going to invest your time, your energy, or your money to manufacture product or a product that you're not sure or do not have the potential to sell. You're not going to have that product sitting in a warehouse somewhere just collecting dust. So it doesn't matter if the Federal Reserve lowers the interest rate even by 1 point. That's not going to stimulate most businesses to go out and make more capital investment. So no, lowering the interest rate is not going to stimulate the economy in that particular situation. Now, some would say that by the Federal Reserve lowering interest rates will lower interest on car loans and also credit cards and mortgages. Now, I'm going to get to mortgages later. But first, let me talk about credit cards and car loans. Now, back between 1950 to 1980, we used to have something called savings and loan banks. But Ronald Reagan, or the Reagan administration, which was the conservative administration, caused the Great Recession of the 1990s. And when he did this, it also caused all the savings and loan banks to close or go bankrupt. So we no longer have any more savings and loan banks. But back between 1950 to 1980s, a lot of consumers, or your average American, would go to these savings and loan banks, and that's where they would get loans for cars, their mortgages, and credit cards. But like I said, in the 1980s, or late 1980s, when all the savings and loan banks went under or closed, that started the decoupling or increased the decoupling of the Federal Reserve Bank interest rate to credit card rates and also to car loans. Now today, because of it, almost every retail store and every airline offers a credit card. Car manufacturers offer financing. Even used car dealerships offer financing. Here in Chicago, we have a used car dealership called Drive Time. And their slogan is, if you got a job, you got a car. So even with used car dealerships like Drive Time, they offer their own financing. So no, the federal interest rate is no longer connected or tied to credit cards or even car loans. Also, before the late 1990s, the highest interest rate a credit card could charge you was 21%. But that is no longer the case. They can charge you whatever they want. That went to the Supreme Court, and the Supreme Court said that credit card companies can charge us whatever they want. So because of that, even if you have a score like 800 or 850, doesn't really matter. They can still charge you 28%. So because of that, the Federal Reserve interest rate is no longer tied to our credit card rate. However, you're probably also going to ask is, well, are mortgages still tied to the Federal Reserve interest rate? And the answer is yes. However, there is a caveat. The average price of a home today is around $400,000. The average American only makes about $65,000. That means that after taxes, his take-home pay is approximately $3,800 a month. Now, for a 30-year mortgage with 20% down on a $400,000 home, you're looking at around $2,700 a month in your monthly mortgage payments. So if you subtract the $3,800 a month of your take-home pay minus the $2,700 a month of your mortgage, you're left with approximately $1,000. The $1,000 pay for food, utilities, put gas in your car, and you may have a little bit left over every month to pay for, cable, and maybe go out. But if you have kids or a family or wife, you're not gonna have any money left over. So because of that, the average American cannot afford to pay for or buy the average house here in America. Now, if you're making like $100,000 a year, and you put 20% down on a $400,000 home, then yes, you can afford to buy a $400,000 home. But the problem is that most Americans are not earning over $100,000 a year. What this means is that if the Federal Reserve lowers the interest rate, it's not going to make that big of a difference on the housing market because most Americans cannot afford to buy a house in this housing market. And the other problem with buying a house in America today is property taxes and property insurance. When you combine the cost of property taxes with property insurance, sometimes that combined cost can be more than or equal to your mortgage. Now what happened was counties and cities are reevaluating people's homes because they need to raise revenue to pay for services such as the police, firefighters, and education from kindergarten through high school. And the way they figured out to do this is to keep raising people's property taxes every other year. For example, you bought your property or your house is worth $200,000. Then the city comes in and it says the following year your house is worth $250,000, so we're going to increase your property taxes. This also means that your property insurance is going to go up because now it has to reflect the new value of your house. What this causes or results in that a lot of people are trying to sell their homes and cannot sell them because their homes cost way too much. So even if the Federal Reserve lowers the interest rates, it's not going to affect property taxes or property insurance or the price of buying a new home. Now what happened was back in the 1950s to 1980s, the federal government used to give the states and counties and cities money for education from kindergarten to high school, for the police department, for the fire department, and for a lot of other local or state governmental services. But in the 1990s, they took all of that away. So then the cities still have to pay for the fire department, they still have to pay for the police department, and also education. So that's one of the reasons why they had to figure out a way to get in more revenue, and the best way to do it is through property taxes. Something else happened was that, like I said, back in the 80s, like it was 1980 or 1982, Reagan administration was able to get the Social Security laws changed. Back then, back in the 80s, all state employees' retirement was connected to Social Security, just like mine and yours is. But after 1980, state employees no longer have their retirement connected to Social Security. The retirement went from being connected to Social Security to being connected to a state pension plan. And all those state pension plans were being run by Wall Street. So your teachers, your firemen, your police officers, and all the other state employees' pensions is not on Social Security, but now connected to the state accounting pension program. Then the Bush administration in the early 2000s, or 2008, caused the Great Recession. And because of this, a lot of those state pension funds was worth, by 2009, half. So a lot of those state employees woke up the next morning in 2008 and in 2009 and discovered that their pensions are only worth maybe half as much as what it used to be worth. Now all that money did not disappear. It went straight into Wall Street, straight into the rich and the wealthy. But the result was that now a lot of states still have to have their pension obligations, but they no longer have the money to pay for those pensions. So now you have to figure out a way to bring in more revenue. And like I said, the best way to do that is through property taxes. So because of it now, property taxes are equal to or the same amount as your mortgage. Now back in the 70s and the 80s, your property taxes in most places were only about 10% of your mortgage. And that's because, like I said, the federal government was paying for, the education, the fire department, the police department. And back then, if the Federal Reserve Bank increased the interest rate, that will affect the housing market. But now, because the property taxes is equal to or greater than your mortgage and keeps increasing each year, it doesn't matter what the Federal Reserve does when it comes to the interest rate, because it's not going to affect the price or the cost of your home. Some say that the Civil War was about slavery. No, the Civil War was not about slavery. Slavery was only a vehicle. It was a vehicle that the rich plantation owners used to become rich and to become richer. The more slaves you had, the richer you could become. Now, during the Civil War, a lot of people in the South died just to help the rich or the plantation owners keep slaves, thus help the plantation owners stay rich or become richer. Now, today, they do not use slavery as a vehicle. They're using tax cuts and cuts to social programs as a vehicle for the rich to become rich or to stay rich and to become richer. So the cuts to Medicaid means that a lot of people is probably going to die. Because if you get sick, you can't go to the hospital, you can't see a doctor. The mega voter or the conservative electorate, they support this. Yeah, you may take health care or Medicaid away from everybody else, or food stamps away from black or brown people, or undocumented immigrants, as you might say, but it's going to hurt you too. Now, what the conservative politicians and the rich are actually telling the mega people want to give Medicaid or free health care to undocumented immigrants. And us liberals are like, yeah, why not? Who gives a damn? I mean, as long as we're taken care of, as long as we don't die, I don't care if undocumented immigrants get them health care. I mean, in some countries like Brazil and Europe, if you show up, you're part of the healthcare system until you leave, if you get sick or injured. And then some of the mega people will also say that they don't want their tax dollars to pay for undocumented immigrants' health care. Now, what they're doing is they're cutting health care for everyone, even themselves. So you're going to risk your little girl being sick and dying just because you don't want to give health care to undocumented immigrants or give health care to black or brown people. So basically, we're still fighting the Civil War. It's still like it was back in the 1800s. These people are still willing to die, risk their health, risk their family health, risk their children's lives to help the rich stay richer and earn more money, while their standard of living decreases, and they wonder why we think they're a bunch of dumbasses. Now, I used to have a friend who was conservative, and what he told me was that all us Democrats or liberals do is to tax and spend. I was like, yes, that's all we do. But who do we spend the money on? We spend the money on you. We spend the money on health care. We spend the money on child care. We spend the money on education. We spend the money on homelessness, on food insecurity. We spend the money on you. Not to make the rich stay rich or become richer. So by lowering the Federal Reserve interest rates, it's not going to stimulate the economy. It's not going to bring down interest rates on credit cards. It's not going to bring down the interest rate on car loans or used car loans. It may help with mortgages, but what offsets it, like I said before, is the increase in property taxes every other year. So when you look at it, it's not going to really benefit the average person in America in any kind of way. Okay, let's say for argument's sake that by lowering the Federal Reserve interest rate, it's going to have an effect on car loans and mortgages. But do you really think that a 0.25% reduction on your interest rate is going to make that big of a deal on your monthly payment? I mean, even if they lower the interest rate by 1%, do you think a 1% decrease is going to really make a big difference on your car loan payment or your credit card payment? However, lowering the interest rate or the Federal Reserve interest rate by 0.25% is going to help one group of people, and that is the rich. It's going to help them because it's going to, affect the bond market. If they increase the interest rate, the bond market interest rate also increases. And if they lower the interest rate, then the bond market interest rate decreases and they just move the money over from bonds to stocks. But who owns the most bonds or stocks here in America? It's not the middle class, it's not the poor, it's the rich. So for us middle class and us poor, it's not going to have any benefit to us whatsoever. Now, other issue is that if they lower the interest rate by 0.25% or by 4%, it's going to have an effect on our national debt and our national deficit. But the rich people do not pay anything towards our national debt or our national deficit. The ones who are going to shoulder that burden is usually the working class or the middle class. Now, I used to be a financial analyst, and I used to work for a few major corporations. And within every major corporation treasury department, financial analysts are hired to create tax plans. And these tax plans that we create every year, we try to have the result that the corporations pay little to no taxes each year, or they get a tax refund for the taxes they paid the previous years, which means that every year, most major corporations in America pay zero taxes, or they get a refund for the taxes they paid in the previous years. This means that when the debt or the deficit increases, the people who are going to be paying for it are going to be the working class and the middle class. Basically, by the Federal Reserve lowering the interest rate is not going to stimulate the economy, it's not going to cause more businesses to hire more people, it's not going to have an effect on your life in any kind of way. It may help lower the interest rate on your mortgage, but like I said, that will be offset by the increase in property taxes every other year. So by the Federal Reserve lowering the interest rate is not going to really help our economy in any kind of way. Now, some would say by lowering the interest rate will have an effect on reducing inflation. This is another supply side theory of economics. Here's the thing. Historically, there's been no proof, no cause and effect, no correlation, directly or indirectly, that by lowering the interest rate is going to reduce inflation or have any effect on inflation directly or indirectly. Now, conservative economists will always say that give it time, it's going to work. Give another 6 months, it's going to work. But nothing ever happens. The conservative economists realize that most people want a quick and easy fix, a magic bullet. But the truth of the matter is, if you want to know what's causing inflation to increase, you have to do the work. You have to look at what is stimulating your economy. How is your economy structured? And every country is a little bit different. Like here in the United States, back in the 1950s, 1980s, most loans, car loans, mortgages, credit cards, were tied to the National Reserve Bank interest rate. But when we look at other countries, like the Philippines, Thailand, Vietnam, most people in those countries cannot get a credit card. Most people in those countries cannot get a car loan. Most people in those countries cannot get a mortgage. And because the way their economy is structured, their national bank interest rate is tied to all of those types of loans. The Federal Reserve interest rates or a national bank's interest rate is only going to affect the economy depending on how that country's economy is structured. If it's structured like the United States or like most Western economies, then it's not going to have any effect to stimulate the economy or reduce inflation. Okay, that's about it. I'm done. All right. Don't forget to like, subscribe, share, and all that stuff. Thanks, guys. Adios.